Good morning, ladies and gentlemen. A very warm welcome to the Sustainability Reporting Review 2021, jointly organized by the Singapore Exchange Regulation and the Center for Governance and Sustainability at the NUS Business School. We are very privileged this morning to have Ms. Grace Fu, Minister for Sustainability and the Environment, as the guest of honor. My name is Rainer from SGX-CGS, and I'll be your host for today's event. This is the second edition of the Sustainability Reporting Review. Some of you might have recalled our previous review in 2019, which was hosted at our auditorium at the SGX Center. Well, unfortunately, due to the pandemic, we are unable to host the forum physically at our auditorium today. But I guess the silver lining is that we are now able to accommodate an even larger audience, which is more than twice the size of the previous event. And in this forum, we'll be presenting the results of our review, then followed by a panel discussion comprising of domain experts and industry leaders in the field. And the full reports and presentation slides will be made available at the end of this event. Throughout the conference, please feel free to type any questions you may have into the Q&A box, and we will do our best to address during the panel discussion. So now, without further ado, I'd like to welcome distinguished Professor Andrew Rose, Dean of the NUS Business School, who will deliver his welcome address. Professor Rose, please.
Thank you. Minister Grace Fu, Mr. Tan Boon Jin, distinguished guests, ladies and gentlemen, good morning. It gives me considerable pleasure to join you today at the Sustainability Reporting Review 2021 webinar. Today's event celebrates Singapore's commitment to sustainable development and a look at how companies have fared since sustainability reporting was introduced by the Singapore Exchange 4 years ago. At the business school at NUS here, we're extremely proud that this is part of the sustainability initiative in greening the economy and protecting our future. And I want to make sure that everyone understands it's simply no coincidence that we renamed the Center for Governance Institutions and Organizations last year to the Center for Governance and Sustainability, CGS, just in January of this year to recognize the critical role that sustainability plays in ensuring our future. Now, the progress of a country has never been measured purely by its GDP or its employment rate, but it's very clear that it's now evaluated to a very large extent by its potential for sustainable development and the preservation of resources for future generations. The erosion of shorelines caused by rising sea levels, severe weather brought on by climate change, all of this sort of thing has heightened the awareness and recognition that business simply cannot go on as usual. Now, of course, right now, we're especially aware of that because of the impact of COVID-19, which has further compounded the problems and highlighted that we really need action. Stakeholders such as companies and investors are increasingly scrutinizing private companies' role in sustaining production and in their sustainability efforts. Today's participants at the webinar comprise corporate executives, investors, professionals, stakeholders from both the public and private sector from a wide variety of industries. CGS has conducted corporate sustainability assessments from 2015, both for Singapore and indeed the entire ASEAN region. The current review by SGX and CGS sheds some light, only some light, but good light, on the journey, the progress, and of course the challenges faced by the reporting companies, and provides suggestions for improvements. We certainly hope that the sustainability efforts by the listed companies are an example for other companies and many other organizations which will follow. Now, to me, one of the most heartening results in the assessment by CGS and SGX is that listed companies are embedding sustainability more deeply into their corporate structures and strategies. There's a notable improvement. 70% of companies which disclose sustainability targets link them directly to their business strategy. That's up from only a third previously. I don't want to say more because I want to leave it to CGS's presentation of the results and of course the panel discussions, which will throw more light and provide more insights into trends and developments. At the end of the webinar, I hope that everyone here was going to be more engaged and determined to preserve and to pursue this journey of sustainability. And on that note, I want to thank the organizing team, especially Mr. Michael Tang and Associate Professor here, Lawrence Loh, for putting this forum together. Let me thank each and every one of you for your participation, and I hope everyone has a fruitful and enjoyable event. Thank you.
Thank you very much, Professor Rose. May I now invite Ms. Grace Fu, Minister for Sustainability and the Environment, to address us. Minister, please.
Thank you very much. Thank you so much. Professor Andrew Rose, Professor Lawrence Loh from the NUS, and also Mr. Tan Boon Jin, CEO of Singapore Exchange Regulations. Ladies and gentlemen, very good morning to all of you. And it is my great pleasure to be here this morning for the launch of a joint review of sustainability reports by Singapore Exchange Regulation and the Center for Governance and Sustainability at the National University of Singapore Business School. This review comes at a time when there's a strong international momentum to advance the sustainability agenda and address climate change. Indeed, climate change is one of the gravest threats facing mankind. As a low-lying island in the tropics, Singapore is particularly vulnerable to its effects, which include sea level rise and potential disruption to the supply of essential resources like food and water. We must therefore build on our sustainability efforts of previous decades and tackle climate change with renewed urgency. We need a long-term plan to both mitigate and adapt to climate change, a plan that will span generations to protect Singapore and Singaporeans. The Singapore Green Plan 2030 is the government's commitment to our present and future generations. Launched in February this year, the Green Plan is a whole-of-nation movement to advance Singapore's national agenda on sustainable development and climate action. The plan charts ambitious and concrete targets over the next 10 years, positioning us to achieve our long-term net zero emissions aspirations as soon as viable. Realizing these goals will require a concerted efforts from everyone to advance sustainability. Individuals, communities, and businesses all have a part to play. The government will take the lead with GreenGov.sg, which will see 4 shifts. First, the public service will, for the first time, set a carbon emissions target of peaking around 2025. Second, the scope of GreenGov.sg will be expanded to include public sector infrastructure and operations. Environmental and sustainability will be embedded in its core business areas, like procurement and education. And fourth, a culture of sustainability amongst public servants will be built. We hope that the direction taken by the public service will catalyze growth and develop the development of sustainable products and services and promote a new growth sector of green economy. In an increasingly carbon and resource constrained world, the ability to operate and produce sustainably will be ahead of the curve will be a key attribute of successful enterprises. In other words, not only are we able to operate and produce sustainability, we want to be ahead of the pack so that this will become our competitive edge. Consumers and corporate buyers have become increasingly environmentally conscious and will place greater value on sustainable goods and services. Companies must embrace environmental, social, and governance imperatives in their business practices or run the risk of falling short of stakeholders' expectations. Investors, too, are paying attention to ESG issues as climate change presents multifaceted risks that cannot be ignored. Besides the physical risks of climate change, such as loss of properties to extreme weather events, the transition to a low carbon economy will impact every sector and fundamentally change asset values. Some assets, such as those in carbon intensive sectors, could potentially become stranded. Actually, as we speak, we have read about the shareholders meetings happening in some of the oil majors in the recent days. And I think these are clear reminders of the shifts that's going on among investors. Investors are increasingly taking a more activist role when it comes to sustainability. So SGX's recent publication revealed that 86% of financial institutions considered sustainability in investment decision-making. Today, more than $30 trillion of assets globally are being managed in ESG investments, an increase of 34% from 2016. Global investors plan to further double ESG assets over the next 5 years. So a company's sustainability report is therefore an increasingly important component of a company's communication. Today, among the world's top 250 companies, a record 96% of them reported on sustainability last year. Increasingly, companies have come to recognize that ESG issues form part of their corporate performance. And when done well, sustainability reporting can inspire confidence among stakeholders and reinforce a company's brand value. SGX-listed companies have made good progress in the space of sustainability reporting. Since 2016, when SGX makes sustainability reporting mandatory on a comply or explain basis, close to 500 SGX-listed companies are publishing sustainability reports. Today, I note that further progress has been made. The latest review of sustainability reports showed that the quality of reporting has improved. There were overall improvements in sustainability reporting scores since the last review in 2019, and it is especially heartening to note that the smaller companies have made the largest improvements. I congratulate all companies for the progress made in sustainability reporting and commend the collective effort by the Monetary Authority of Singapore, SGX, and professional bodies such as the Singapore Institute of Directors in raising reporting capabilities. I also thank NUS for the thought leadership provided in this space over the years by spearheading relevant and high-impact research on governance and sustainability issues, including this round of review. Let us build on the progress made in this space and continue to seek ways to further improve ESG reporting and disclosures together. While good reporting is important, we need companies to embed sustainable practices in its operations. The government is supporting these efforts. To be more resource efficient, companies can tap on NEA's grants such as the Energy Efficiency Fund and the 3R Fund. Enterprise Singapore, ESG, is developing the Enterprise Sustainability Program to support local enterprises in developing new capabilities in sustainability and capture new opportunities in the green economy. More details of the program will be shared later this year. The government is also facilitating the development of green financing. The first of its kind Green and Sustainability Linked Loan Grant Scheme, or GSLS, was launched last year to support companies, including SMEs, to obtain green financing. The Sustainable Bond Grant Scheme, or SBGS, was also enhanced last year to help companies defray the cost of issuing green, social, sustainability, and sustainability-linked bonds that align with international standards. Let me conclude. Sustainability and addressing climate change must be a priority for businesses to thrive in the long term. Companies need to embed sustainability in their DNA and recognize that going green is not only good for the environment, but good for business as well. The government will play our part to support companies' efforts to become more sustainable, including through grants and funding. I commend all companies once again for the progress made on sustainability and sustainability reporting. I urge companies to continue making strides in incorporating sustainability into your businesses and play your part in the nationwide movement to advance our sustainability agenda. Together, we can make Singapore a global city of sustainability. Thank you very much.
Thank you, Minister, for the very timely reminder that we all have a part to play in combating climate change and building a sustainable future. May I now invite Associate Professor Lawrence Loh, Director of the Center for Governance and Sustainability, to present his findings on the disclosures made by our issuers. Prof. Loh, please.
Thank you, Rainer. Let me just test my remote control. All right, good morning, Minister Grace Fu, Mr. Tan Boon Jin, Dean Andy Rose, friends. Greetings from NUS Business School. I'm actually sitting alone here in NUS Business School, trying to handle the substance, the process, and also the technical aspects of this seminar. I have 3 devices in front of me. And I think this is something very apt because, next slide. Because, when we talk about sustainability, all the leaders in sustainability actually have to multitask. They have to manage so many things, the substance, the process, and the technical. And sometimes you are actually very alone. But never mind, I think it's very important that, as Minister said, we have to work in the collective, and we have to actually go for the substance as well as the continuity. So for today, next. We are going to look at 4 aspects of the presentation: context, methodology, results, and summary. And as the host has said, the slides and the report will be available to all of you at the end of the seminar today. And also, I like to also encourage all of you to put in your questions. In fact, the questions can be to be asked now. Next, please. Let me just look at the context for sustainability reporting. And in fact, for the rest of this morning, I'm going to use a very narrative, tell story approach towards highlighting many of the, I would say, more technical statistics, descriptive statistics. Next, please. If you look at the industry context, of course, there are 3 main forces that are affecting all of us now. I think all of us are probably losing sleep over, particularly, say, the pandemic that's going on. And now, many countries are having very severe subsequent wave beyond the, the initial hiccups last year. And of course, climate change is very important. And now the biggest boom, and very rightly so, is sustainable finance. Investors more than ever are turning their attention to green finance products, and also in terms of the assessment of investor targets that sometimes they want to pull up. And I think for these 3 areas, I'm very happy to say that later on in the panel, we have industry experts that can address each of these particular arenas. Next. If you look at the policy context, I think just to lay out very, very briefly, all of us, as Minister Grace Fu has mentioned, in fact, Minister Grace Fu was the one who announced the Singapore Green Plan in 2030 in February this year in Parliament. It's a multi-ministry approach and a whole of nation campaign movement to push the envelope for our national agenda. And very aptly so, in a very specialized manner, just late last year, MAS, and I think one of the panelists will be a leader from MAS later on. We are starting off very rigorously, at least in the environmental aspects, for 3 targeted groups. And I think eventually we will want to expand to the rest. For these 3 groups, these are very important intermediaries and enabler for the rest of the economy sector. So I think this is something very, very important for all of us to take note of. And I think Mr. Tan Boon Jin is here together with his team at SGX-RegCo. Right now, we are going to advance some of the consultation coming out to further strengthen, further enhance many of the requirements. So I think that this policy context, together in the industry context, will let us, move towards real sustainability in a more calibrated, in fact, even more protracted way. Next, please. If you look at what we have done, today's topic for this webinar is basically to have a broad review of what is going on. So I will highlight some of the key aggregate results that we have done with a team, my research center, with a team from SGX, and of course, doing this, my compatriot, my co-head of this project is Michael Tang, the head of listing. Head of listing requirements and SGX RegCo, and I also have a team at the center to do it. Next, please. I always like to start with the assessment framework. In fact, in my day job as a teacher here, as an educator here, usually this is one slide that everybody is interested to look at upfront. So maybe I'll just highlight this. I think much of the audience will probably know that sustainability reporting is now mandatory in Singapore. Listed companies is in the 2 of the listing rule A and B, 711 A and B, and also some of the recommendations for best practices are captured in the practice note 7.6. So I must say that it's mandatory to have sustainability reporting, but there are 5 components, 5 primary components. If you look at the chart there are 6 items there, from second to the 6th items. These are the 5 primary components. These are on the comply or explain basis. So we have a very, I would say, elaborate framework that my research center has developed with SGX RegCo to track the progress of some of the sustainability practices and disclosure, in particular of the companies. Next, please. And beside the 5 components, we also, as a first item, look at some of the best practices, which is somewhat called the reporting principles in the practice notes. There are quite a number of them, but we highlighted 5 of which that are most important: stakeholder engagement, all the way to balance reporting. I will share some of the results with you. So this is the starting point. Let me now go on to the report card for the year, and I think this will actually ignite maybe the panel discussion. Next slide. Next slide, please. Yeah, okay. So if you look at the scope of review, as was said just now, there was a previous review 2 years ago, which covers, somewhat less issuers, because at that time, many of them were not in yet. But now we cover a little bit more. 566, there are 700 over listed companies, but because many of them are not listed here in the primary basis, some of them have halted trading. So with all the technical elimination, we have 566 issuers, and we capture information up to end of the year in December. So many of the information are actually quite up to date as of now, up to December last year. And I must at this point stress that our assessment is based on disclosure for very good reason, because stakeholders, particularly investors, make their decision based on disclosure of companies. They do not have perhaps access to the internal processes or information. They have no opportunity to go inside the black box of the companies. Also, they have to actually look at disclosure, which is why one of the issue is how authentic, how accurate, how valid, how credible this disclosure is. I think that this is one of the issues probably we have to pay more attention to. And many of this information can be done by companies in standalone reports, or actually many of them actually put it into their annual report or integrated report. Next, please. Let's look at the overall performance. Next. Okay, the overall performance. This is the integrated scorecard. The from last round in 2019, we have improved from 60.6 all the way to 71.7. We have a somehow it's very nice number. 11.1111 improvement in the absolute score out of 100. But I think this is good in terms of average. But I think what is actually even more heartening, even more encouraging is if you look at the chart, you can see two curves, two distributions. The blue is the previous round, somehow it's quite normal. Normal distributions. I think professors love normal distribution. I mean, that's what we always like the student scores to be like. But now we have a happy problem. It's more tilted and shifted towards the right, which is a happy problem because many of them are actually improving. In terms of the scores, the rate curve has moved much to the right, closer and closer to the 100 points. In fact, from 90 to 100, in the past, you barely have very negligible, almost like one company. Now you have almost 5% of the company in this range. And if you look at less than 20 marks, I think none of the companies are below, below that. So I think it's a very, very good sign. But let's look at this distribution in terms of their board categories. In Singapore Exchange, we have two boards. Next, please. Catalyst and the main board. Catalyst is the secondary board. Some of the listing requirements are slightly less stringent for very good reason. And you can see on this chart, the red bars are for this year 2021 results based on December 2020 information. In a very simple way, you can see, of course, in terms of sample size, most of the companies, 385 are main board, only 181 are catalyst. But even if you just simply look at the average, it's very, very interesting. In fact, very notable that catalyst company seem to do slightly better, in fact, much better than the main board company. And in fact, this was a reversal of the last round. And I should say up front that one of the factors driving this, I will have a next slide on this, but maybe I'll say this up front now. The main board is actually put down by the smallest company in this category. Is put down. The large companies are doing very, very well. Catalysts more or less are quite uniform. In fact, I personally look in detail at some of the top performance in catalyst company. It's very interesting. They do very well disclosed, very good practices. And maybe one of the reasons is because of the nature of the way catalyst company are being guided. They have sponsors to help them, or maybe because the scope of the operation being small are less complex, so it's easier to jumpstart and go into sustainability. Next slide. Let's look at the effects of size. And I think that this is something very revealing. There's almost a very certain size effect going on. Of course, we can do more complex statistical analysis, but just by eyeballing three categories, you can immediately see an obvious trend. The big cap company, which is defined there, more than 1 billion in terms of market value, do much better than the mid cap and the small cap. So there's a size effect. There's previously in the previous slide, there's a category effect. Next slide. Let's look at whether there's an industry effect. So we use the standard stock exchange, Singapore Exchange category 11 sectors. This is based on GICS, which is the Global Industry Classification Standard. This is used by all the major stock exchange. You can see on the right side, real estate tends to do the best for very good reason, but of course there are many types of real estate. Communication services, which include telecoms, also do very well. On the left side, very interestingly, in fact, this is one of the surprise that I have. The financials don't seem to do well, but of course there are 25 companies of them. And I must upfront say that these 25 companies is a mixed bag. Next slide. In fact, just as an illustrative note, within each of the 11 sectors, there's within sector variation. So just by example, I pick the financial sector as an example. This is a sector where the variation is the largest among all the 11 sectors. I just pick out some of the standard deviation for this sector versus all sector. You will see on the right side, the variation in financial sector actually far surpass the variation in all the sector. I must upfront say that all these may not be licensed entity by the relevant authorities in Singapore, including MAS, but they are, of course, include the 3 big banks, insurance companies, financial houses, investment company. There's even entities they are in the pawn business, pawn shops, so to speak. So you can see, it's quite a different sector. So I think in the 11 sectors, many of the variation is also, exist within each of the sectors. So I think later on, if we want to have policy intervention at the sector level, we must also see the variation. Next slide. Let's look at some highlighted results very fast, very high. There are a lot of results, but I just look at some of the general principle first. Reporting scope is very good in terms of the increase from the last round. In fact, almost all of them, 90% of them, specify the scope, which is one of the basic requirements of sustainability reporting. You have to, delineate your boundary of your concern. So I think almost 100% there, 90%. But many companies, in fact, just over half explain how they scope the company. Don't just scope and take it for granted, but tell a story behind that. In fact, it's quite surprising. Only barely 61% cover subsidiaries. So, and in fact, you don't even need to outsource sustainability. You can just pass it to your subsidiary. You are not covered by your main company. This is one way to perhaps shift some of the issues to your subsidiary. And as a new measure, for this round, we see whether they cover the full business operation, the full value chain, only about 1/5 of them. So I think in terms of scoping, there's a lot of room, I would say, for improvement. Next, in terms of materiality, now very good because it's part of the reporting components. 100% full score, identify their material factors. But for this round, in terms of justifying, elaborating on their process, on their consulting of stakeholders, it seems to drop. So I, together with my team, we try to analyze why it happened. What we found is not that they have not done it. Many of them simply just don't disclose it. They just say, based on the last, our last round. So they use the historical basis. So my advice to companies is, even though you have done it before, make it an effort to disclose it in your current report, because every report sometimes is taken in itself. It must be a self-contained report that has all information. Don't rely on previous information and expect investors to look at the 10-year series of reports that you have. Every report should be complete in itself. So this is one weakness in terms of this. Not so much that they have not done it, just that they don't take the trouble to disclose. Next. In terms of another component, this is another component. Okay, policies, practices, performance. You can see performance data, meaning sustainability performance, not the financial performance. So you are looking at, for example, in the environmental aspects, some of the real measurement that they have done. Example, carbon emission, waste, electricity consumption, or in your social, some of the statistics in terms of workplace safety and so on. Very good, almost full. Okay, number B, look right in the center. This is a very interesting, I'll say, indicator. We look at the linkage to top executive remuneration, meaning the top management. How is it linked to sustainability performance? Only about 1/4 has some semblance of relationship. I'm not so sure whether this is good news or bad news, but maybe is there a way, or should there be a way for us to make a more explicit interfacing between top management incentive and sustainability reporting or sustainability performance. And of course, targets is very good. Now this is something very good. Performance is now described in accordance with target rather than just stand alone. About almost 2/3 of them have done it next. Okay, in terms of targets, since this is part of the 5 components, let me just explicitly say something on this. You can see that many of them have targets. Short-term targets go up quite sharply because this is one of the requirements of the compliance, which is the current year of targets they have to specify. So I think because they have moved to targets, short-term targets as part of the requirement, many of them start to be more silent on the longer-term target. In fact, in the last round, the surprise is everybody have long-term targets, very few have short-term, because for some strange reason, they say, let's have longer-term targets, and then, maybe I'm not around anymore in this area when it's time to measurement, but now it's good. I think it's more balanced. And I think, as my dean mentioned in his opening address, the linkage between targets and business strategy is now more clear. It's a sharp 2-fold increase. I think this is very good news for business school. Link between targets and financial performance, good but not so good, is still below half. Okay, next. Okay, a few more other statistics. Reporting framework. I just want to highlight that almost all companies have a proper framework. And among those who have framework, this is something very interesting. Almost all of them, in fact, 99.1% use the GRI. GRI for the uninitiated, Global Reporting Initiative is the gold standard now. But of course, there are some other competing alternative standards that can be done, that can be adopted on a holistic basis. For example, SASB, Sustainability Accounting Standards Board, standards. And not many of them explain their framework that they use. They just adopt it without explaining, without saying how relevant it is to their business. Okay, next. Let's say, okay, this is one interesting thing about their board commitment as exemplified or explicated in the board statement. Many of them, consider as part of their strategic formulation sustainability, but in terms of, say, overseeing management, they don't disclose. Maybe, of course, they do. I'm sure they do, but just that they don't make the effort to disclose them. So sometimes in sustainability, the main thing is don't take things easy. When you do things, always close the loop by stating it. So to assure the stakeholders who are reading it, sometimes things are so obvious, but it is good that you make some additional effort to comfort or to assure shareholders, stakeholders, investors. Okay, next, please. Okay, let me look at the key reporting principles and then just a couple of them. Okay, next. In terms of assurances, I think this is one topic that comes out, and I'm sure this will come out quite a lot in the panel afterwards. Internal has gone up, but still not quite there, barely 1/5. External assurances remain constant, more than just the Big Four accounting company. There are a variety of niche players, standard setting bodies, but right now only about 2.8% of them. In fact, I was personally looking at many of the reports to see what is the pattern. In many companies actually do it for specific parts of the report, and I think many of them will actually do that for their environmental part, which is a good start because many of these are quantitative indicators, quantitative results. So they actually do it for many of their environmental. So framework used for assurance, not very much. This is the standard, I'll say, is the stakeholder engagement standards, standards on assurance engagement by Singapore ISCA or by International Federation of Accountants. It seems to drop. I'm not so sure whether this is a good sign. They just do assurance without referring to some best practices. Maybe we should promote the standards a bit more. Next, please. Okay, in terms of balance reporting, the good news, if you look at the center, more companies are now amenable to reporting unfavorable. In the past, it's always, report everything favorable. In fact, for 2 years, 100% favorable aspects are always reported. But in the last round, slightly over half talk about negative aspect. But now maybe in the last year, 2/3 of them, but still not good enough. I know there are some examples. For example, in social, some of the labor relations practices, workplace safety, accidents, or even pollution when they are being, fined by authorities in Singapore or elsewhere. More of them are now more amenable to disclosure. Next, please. Okay, just a couple of topics of interest, and then I can conclude. In terms of topic of interest, our reports were up to December last year, so probably it captured many of the information, probably only up to middle. Actually, some of them might even put in beyond the reporting year, but roughly, in the second half of last year was, it's not a very definite cutoff date, but you can see that as of that date, maybe about almost 2/3 of them disclose things related to COVID-19, which is good. I think by now, companies should definitely disclose this even more rigorously. In terms of specific thing, many of the economic environment is much less, social is actually very good. Okay, one more topic of interest, then I will conclude in 1 minute. Yeah, okay. Yes, climate change. Climate change as one of the factor in economic, environment, social is barely half included in the sustainability performance data in terms of climate change. For example, some of their actual environmental indicators, for example, barely, just over 1/3. Use of reporting framework for climate change, barely 2%. And some of you may know there are many standards that framework that can be used. For example, maybe in the panel we can talk about it. TCFD, for example, Task Force on Climate-Related Financial Disclosure. CDP, SBTI, the Science-Based Target. Next, okay, let me just conclude and summarize just before the panel. In terms of aspects for attention, let me start with the lowest, the absolute lowest quantitatively among all the factors that we have thought is external relations. And in fact, very, very closely, this is those that are highest is the absolute lowest. So internal assurance, external assurance are at the bottom of the totem pole. And then impact of risk, covering full business operation, linking top. Also, these are not quite there in terms of specific factors. But let me end perhaps with a positive note. So what have we done well? By the very top, in fact, I'll show you 100%. Materiality is something quite well done, 100%. Material factors is there, reporting framework, all of them use it. For those who use it, they disclose. Performance data, particularly on some of the aspects, stakeholders in terms of identification, but not so much the process, and setting good targets, particularly of the immediate targets. Okay, let me just highlight. So overall, these are the 4 key points. General improvement across the listing board sector size overall, but of course there are some nuances and differences. Potential for improvement for specific areas remain, which I have highlighted. So number 3, as company continue to mature in sustainability reporting, they'll be prepared to manage risk and opportunities. So I think it's definitely, and I think in a very specific way, I think there's really opportunity, the scope for further policy enhancement, especially in assurance and climate change. All right, so with that, let me conclude, and thank you very much for your attention. Before I hand it back to the MC, I think if you have questions, put it into your Q&A, and then the panel together with me can answer some of this. So may I hand it back to the host, Rainer?
Thanks.
I hand it back to you now.
Thanks very much for the presentation, Prof. Loh. The next segment of our program is a panel discussion moderated by Prof. Loh. May I please invite the panelists to turn on your cameras and to unmute yourself. The panelists will be discussing their views on the state of sustainability reporting amongst listed companies in their capacities as the regulator, investor, lender, and last but not the least, listed issuers. Please allow me to quickly introduce them before we commence today's discussion. First up, we have Ms. Abigail Ng, Head of Corporate Finance and Consumer Department at the Monetary Authority of Singapore. Next, representing the investor's point of view, we have Dr. David Smith, Head of Corporate Governance at Aberdeen Standard Investments. We're also very happy to have Mr. Eric Lim, Chief Sustainability Officer at UOB, to provide his insights from the lender's perspective. And last but not the least, we have Ms. Lynette Leong, Chief Sustainability Officer at CapitaLand. I'll pass the time back to Prof. Loh. Prof. Loh, please.
Thank you, Rainer. Thank you, Rainer. And I believe the whole panel is full force and all of you are on camera and unmuted. Okay, very good. We can now get on to business. And as I mentioned, when I started my presentation, I say, people leading sustainability, whether in companies or at regulation and policy, all of you are actually multitasking a lot. In fact, looking at the content, the process, the technical aspects, particularly the, in the environmental part, all of you are pulling rabbits out of the hat all the time, performing magic. So for this panel discussion, we are going to see how you can pull the magic out of the hat to look at some of the key issues. And I know because of the limitation in time, I won't be able to read out your whole CV, but I might, along the way, within some of the standout points in your CV when we discuss the panel. I have 3 key points, but rather than go through each of you, I will try to weave in along the way. Okay, maybe let me do a broad starting, and I don't want to call out anyone in any order. I think voluntary is better. Let's have a broad starting to find out from each of the panelists. What is your overall sense about your findings? Are there any standout points? Or more importantly, are there any surprises? What is your general feel, your gut feel, or about some of the things in the review that SGX has done with NUS? Anyone know?
Hi, Prof. Maybe I start off first.
Okay, Abigail, yes, Abigail, yes.
First off, I just want to say thank you, and I want to commend SGX and NUS Business School on consistently putting out this report and doing the work in basically doing a dipstick about the sustainability disclosures landscape. So I think it's always very useful and really appreciate the work that has put in this. I think there are a lot of interesting points, but I think generally when I saw the report, I was heartened to see the improvements in the performance of issuers disclosures, from the last report. I think what I was quite heartened to see, especially, was generally more balanced disclosures, right? Not just all good news. You have risks as well as opportunities. And there was also the positive and negative trend analysis, which you had in one of your slides as well. So I think this is really important because investors need complete information, right? So they need to know both the risk and opportunities facing the company so they can make better and more informed investment decisions. So that was one thing that I think struck me. And I think the other one that I wanted to highlight was that I think climate change disclosures, maybe that is something that I think everybody can do a little bit better on. There was an increase, I think, from last year in terms of number of issuers that actually talked about climate change. I think in the 2019 report, it was like 6%. So I think that's really improvement. But I think what we noted was that there are very few listed issuers that are actually adopting a reporting framework that is specifically adapted to and relevant to climate change disclosures. I think from the report, it was like less than 2% that was actually using the TCFD in making the climate related disclosures. And I think the TCFD is something that is quite well regarded. It was rolled out in 2017, but I think it's gained a lot of traction, right? And I think the need to coalesce around a common reporting framework, I think that would really help improve the consistency and comparability of climate-related financial information so that everybody in the market can access that, can look at that for a good way to do climate risk analysis and investment decision making. So I think those were like the 2 points that stood out to me. Thanks, Prof.
Thank you, Abigail. And I know in MAS, beside your current position, you have done capital market strategic planning And I'm very happy to see your judgment because you are a lawyer in professional lawyer passing the
Don't hold
verdict.
it against me.
Okay, thank you. So, maybe let's go on to one of another learned panelist. Anyone who wants to volunteer? Is that David? I see some action.
I was going to, but Lynette looks primed, so I'll let Lynette go first.
Okay, Lynette, I think David has
Thank
given
you,
out
David.
his
You're
slot
very
to you.
kind.
Lynette.
Prof, I was going to say, but then when you said learned, then it kept me from stepping forward. But I'm Lynette, not learned. So yeah, I actually, like Abigail, I'm very heartened to see the improvement in scores. After all, sustainability reporting was only mandatory from 2016. So in the past 5 years, you see this improvement. I think it's very encouraging for everyone. So I think that what stood out for me was when you compared the different industries, and of course it's very encouraged to see that real estate is on top. And I have an explanation for that. Maybe we can discuss later on. But I'm glad you also pointed out that the financial industry sector is low because of many factors. And I think when you deep dive into the specifics, then you realize why. So I think there's a need to really deep dive into why certain statistics are that way. So in the broad brush, it may seem to be, there are differences. So I think, Prof, you did a good job in being able to highlight that, so maybe that's an area which we have to focus on and see where we can improve to pull up the scores of everybody else. So in general, I'm glad to see that difference. On climate change risk, I guess it is still a very, I think, a very complex subject for everybody. So that's why I think there needs to be proper guidance as to how each of the industries will have to report it. I think at least for the real estate sector, we are doing a lot to combat climate change, and there are certain standards in place which allow us to report. So maybe that's helpful to us. But in other industries, it may not be as well defined. So while some industries, some companies may already be doing, they may not be properly guided into a certain standard or a certain framework in reporting climate change risk. So I think that's maybe one of the few points that I'd like to bring up. But there's so much to discuss. So over to you, David.
Yes. Thank you, Lynette. I think you must be very learned because you hold 2 degrees in estate management from none other than NUS. Okay, David, actually you're even more learned because you have a PhD in corporate governance, but never mind.
Yeah, never mind that. But just briefly, I mean, the results, obviously, to echo what's been said before, are very positive, and I think it's good to see that positive momentum. You see the skew move to the right generally for the survey, so that's very encouraging. I guess as an investor, we're always looking for more, and investors are never generally ebullient in our processes, in our emotions. I think the slides that stood out for me were the way that there's perhaps still a little bit more ways to go in terms of linking some of this reporting to longer term targets, to strategy, to the longer term financial performance. And that comes down to, I guess, in effect, the philosophy or the reason for the reporting that we're looking for, because obviously we're seeing a huge amount of change and pressure on businesses because of environmental issues, because of climate change has been referenced. The minister in her earlier comments referenced stranded assets. I think the investment community are focusing on stranded business models. And so when we look at reporting, what we really want is an insight into the way that business models are sustainable and a position to adapt to the changing environment. And so I think as an investor, what we want more of is not just the reporting and the metrics and the data and the sort of quantitative targets, but pulling this together and wrapping it together in strategy, and what does this mean for the business model of the firm that we're looking at. And so I guess a little bit more informational output rather than data output. So that's a slight niggle, and I apologize for being too negative, because generally I thought the survey results were very positive and encouraging in terms of the positive momentum that we're seeing.
Yes, thank you, David. Yeah, momentum is there, and you talk about sustainable model, information rather than statistics is actually more important. Okay, thank you. Before I move on to the next person, next panelist, there are a lot of questions coming in. Some of the questions I see in the Q&A part of Zoom are statistically very particular. So I will show you that my research team will type in the answer to statistical specific question. I will only highlight more broader questions that that will be answered by the panelists, but other more clarification type, my research team, please continue to answer it live, type the answer. Okay, let me just move on. Any surprises or general very quickly to any of the panelists?
Let me throw in my 2 cents worth, right? I am in a very unique position on this panel because I see Abigail, who's my regulator, I see Lynette, who's my customer, and then I see David, who's an investor. So all of a sudden I feel very cornered on this panel. But I will say that the results of your report are encouraging from the standpoint of material factors and stakeholders being some of the areas that we're doing well in. And I think this is really important because as we go through the materiality assessment, what people may think is important or material to a business model, to David's point, may not be what you see in the headlines in the media, right? It takes a bit of real thought and stakeholder engagement to truly understand what matters in terms of the sustainability of a sustainable business model, which is David's point. I do think because of that, it's important that we don't over-focus on single point issues from a sustainability standpoint. I know climate change is very hot right now, and it is very, very important to Abigail's point on TCFD reporting. But one of the things we do at UOB, and we think it would be a good best practice, is to also look at all the 17 SDGs and better understand how your business model either contributes, aligns, or may detract from the SDGs for a more holistic view on sustainability. Back to you, Prof.
Yeah, thank you, Eric, and I am very interested to hear that because Eric actually is very interesting. You transit from finance into sustainability. You used to hate group finance and many other things. You are accountant by training, so I am very impressed with how you made that successful transition. And I'm learning from you because you say we have to be holistic. All the more. So talking of that, maybe let me move on to is there anyone else who have not spoken? I think everybody has spoken. So I will perhaps move on to the next topic of discussion in terms of what we need to do, maybe intervention. I think one key point is the size of company. Maybe we can tackle the size, type, and industry all together in case you have any burning issue about the demographics as well as the profile of companies. Do we need intervention? Do we need solutions? Do we need policies to cater to the differing type of companies? Because we cannot have a one-size-fits-all in sustainability policy and practices. At the same time, if you look at, say, the current standards, of course, they are moving very fast and improving very fast. Most of the thing, including even SGX, we have the basic parameters for all companies, all industry, all sizes. So what is your take? Whether is there a push for more refined differentiation, or are we happy that this is a baseline approach is better? Anyone? Yeah, any one of you? Yep.
I can give my high level.
Yeah, go ahead, David.
Okay, David.
No,
yes.
I can give some high level views on this. I was very pleasantly surprised by the performance of the smaller companies in your survey response. I think there's statistical questions around the way smaller companies perform well versus the slightly smaller large cap companies, and we can perhaps get into that later. I think the reason I'm surprised is because I guess one concern that one might have is around the bifurcation of access to knowledge and advice that we might have in Singapore between the large and the small companies. I think the risk is that the very large companies are very resourced and very well resourced and have the ability to tap onto external expertise, as we can talk to assurance later, but also about more strategic advice. If we look at some of the industries that dominate Singapore, effectively it's banking and finance, offshore oil and gas, and real estate. And certainly for the latter two, real estate and oil and gas, you have extremely long tails in supply chain, which have a lot of smaller companies, but will be materially affected by some of the issues we're discussing here. So the concern we've had is how we can make sure that the smaller companies are getting access to good advice in terms of the business models, not in terms of just how they disclose, but in the ways that they can pivot their business models and adapt their business models to some of the changes that are coming down the pipe or that we're feeling already. So the survey response is encouraging, but the question is whether that is just a disclosure tick in the box, or whether that's whether they're getting the right advice or getting access to the right knowledge to allow them to adapt, because we're going to see some quite sizable impacts on these industries.
Okay, thank you, David. Abigail, you want to
Yeah, thanks, Prof. Thanks, David.
Well?
I just want to speak to David's point. I think he's really kind of like put the finger on it about the smaller companies, and I think that was an interesting observation as well that I had, and I was just thinking for possible explanations. One of it was I thought some of the smaller issues and catalysts, which I mean we're talking about, people are acutely aware, right? If you need to grow and if you want capital flows, you're going to have to pay attention to sustainability. So hopefully, with the optimistic point of view, I mean that's why it's driving some of that disclosure. I think, but I take David's point, a disclosure and versus what that disclosure looks like and how deep it goes, but it speaks to in substance. That's probably a subject of another report that Prof can do for us later on. But I think it's good to start on the journey, right? You have to start somewhere, and sustainability journeys are going to be a long one, and everybody has a different starting point. And I think regardless of the size of the company, I think to just start to get on the bandwagon as soon as you can. And actually thinking about it, a smaller company, actually, if it has less legacy systems, maybe it's flatter organizationally, some of them actually can leverage that, right, to be more nimble and agile, to adapt faster, to kind of like get the sustainability reporting frameworks and systems running faster in their company. So that was kind of like how I tried to figure it out. And I think on the point of resources, generally speaking, I mean, we all know, right, bigger companies will have better resources, better support. But I think happily in the sustainability space, there are quite a lot of freely available resources available in the public domain, which I think has been put out there by a lot of NGOs and non-profits. Like TCFD has a knowledge hub, right? Which companies can go in and find case studies from other organizations. It's like a peer learning group. So I think that's really helpful. They also, in that peer learning group, I understand they also have sharing lessons learned. You kind of like learn from someone else's mistakes, so you won't repeat that. So I think as more of these freer online resources come on, hopefully even smaller companies can find themselves well equipped on that front. So I think, yeah, that was what struck me as well. Thanks, Prof.
Okay, thank you, Abigail and David too. I'm trying to integrate your answers also with some of the questions I'm seeing. There are so many questions, but I will integrate on the spot. David mentioned something about check the box. In fact, there was already a question on checking the boxes, and I love this comment by Abigail about legacy system versus adapt faster and assurance. So by combining a few questions and your initial answer, let us look specifically into this issue of check the box and assurance. And in fact, even in my personal research with companies, my research team together with me, we have discussed many of companies, actually, some of the better ones, they ace the whole rubric. Seriously. I even saw one company that they almost have the whole GRI standards all mapped inside that. They just tick, they score the points. So I think how do we actually handle this issue about checking the boxes? And I think maybe this is also now a good juncture for us to look at the specific issue of assurance. And I think this come out also in a couple of questions. Without reading the long questions, this came out as a keyword, policy enhancement regarding assurance. What do we have in mind? Abigail might even lead us from the regulator or from the investor or from the customer. That Eric mentioned, you're torn between three levels now. investor, customer, and regulator. Who do you love most? So, okay, let's put all this issue together. Center and assurance. Anyone?
Eric, as legal counsel, I think you should just take the fifth on this. Yeah, question about who you love most. Yeah.
Actually, I'll take the lead on this one because it is something quite near and dear to, I'm sure, for both Lynette and myself as reporters, corporate reporters. It is a real challenge, right? Because as you look at how sustainability demands, disclosures, reportings are going, there are, number one, a lot of different standards. Number two, there are a lot of indexes, that rate you on your sustainability performance, and each of these indexes have a slightly different slant. Number three, you've got different stakeholders who are looking for different things. For example, David, as an asset manager says, the more the better, right? But for some other stakeholders, simplicity is best, right? The ability to focus on what really matters. So one of the things we do find as a corporate reporter is we're pulled in a lot of stakeholder directions across a lot of standards, across a lot of lenses, and it truly is a challenge. So I think one of the important things to realize is with sustainability reporting, it starts as a journey where when you are new to it, you're not so secure yet about how to talk about your business and your sustainability strategy and journey. You try to cover all the bases because you don't want to leave any base uncovered. But as the strategy matures, as the reporting matures, we need to be able to shift from covering everything to covering the stuff that really, really matters. And Prof, this is exactly to what Abigail kind of mentioned. Today, a lot of these assessments are on completeness and comprehensiveness of meeting the checklist. But tomorrow, we really need to be shifting some of these assessments to the quality of the exposure, the depth of the disclosures, and the depth of the disclosures. Hand that back to you.
Okay, thank you, Eric. Anyone want to add? Lynette? Yeah, Lynette, yes.
So since I'm the other corporate disclosure, I hear a lot about the word journey. Abigail said that, Eric said that, so indeed, I think sustainability reporting is a journey. For us, we started reporting since 2009, even before it became mandatory. And at the time, of course, CapitaLand was not as big a company as today. So it was tough where there was, we were trying to grow because there were not as many resources around. And I think I speak this to encourage those who have not started this journey, because you have to start somewhere, you start disclosing. And I also want to encourage companies to think of sustainability reporting. It's like an annual report. You should put the same standards as for reporting an annual report where you have external assurance. And you want your investors to look at your report with absolute confidence that you are reporting the right thing. So in sustainability reporting, it's not just the investors who are looking at it and very intently nowadays. It's also your other stakeholders, your customers, your employees, the regulators, the community, and your supply chain. So it's a much broader scope where you are accountable to, and you have a fiduciary duty to as a listed company. So in that sense, the assurance becomes even more important. So in CapitaLand, when we started reporting in 2009, obviously it was tough, but we got it audited the following year. Not externally assured, but audited. So it started from there. And then 3 years later, we got it externally assured. So since 2013, we have had external assurance up to the AA 1000 standard. So it is a journey. It takes a while, but it is, I think maybe the comfort that we draw on in the real estate industry is that there are several guiding principles. There are several standards that we fall upon. The standards are, I think Eric has named them already, the whole bunch, and this is actually not easy, but it is, you need to adopt certain ones at first and then you go on. But I also want to applaud the regulators to have also started this journey. And then from the real estate side, the Building Construction Authority, BCA, has also helped a lot. You know, from the regulators' perspective, it's not just about putting rules and regulations for companies to comply, but there's also assistance given. So in terms of, for example, in the real estate industry, is about green certification for a start. So they have, in order to promote green certification, they came in with financial incentives. And of course, today the incentives have drawn out a lot, and it's been reduced tremendously. The criteria have also become more stringent, but the industry has already developed a momentum of its own. So I think that has been very helpful for the real estate industry. So that's perhaps one of the reasons why you see a big proportion of real estate sector having good disclosure standards. Another one I want to applaud the MAS and SGX for is the SREIT industry. And then, as you know, SREIT is now about 12% of market cap. And a lot of the SREITs, and as well as Capital Land, we also go by another layer of standard, and that's there's a benchmark called the Global Real Estate Benchmark, which is used by more than 1,000 institutional investors. They look at that benchmark, compare that against other real estate companies across the world. You know, so there's this global standard that we follow, and there are also specific principles that guide us to report from ESG perspective. So I guess all these standards are very relevant and helpful for us to go on a certain, I guess a certain stream, a certain standardization, a certain consistency.
Okay, then thank you, Lynette. I have a happy problem. I have so many questions coming in. I will just integrate the essence of most of the questions. And in fact, I was just doing an integration with many of your comments by the panelists. I think one of the issue that comes across commonly across many questions and also your comments is this integration of sustainability with the business, the alignment, the nexus. So you know that piece is very important, and all the more is quite unique because we are now talking about climate change, and climate change is an issue that most companies, in fact, I know almost all they talk to say that this is something remote to me. Who cares about the rising seawater, the temperature? I just want to run my own business. Also, how, you know, in terms of the broader mandate of integration, and also now the coming mandate that has a lot of free rider problem in many corporations. How do we manage as corporates? How do we manage as regulators, as investors? How do we navigate such that there's a convergence so that climate change is something important, yet at the same integrated into the business in some coherent and logical way? Anyone?
I can perhaps give some comments on that convergence, and then my more learned panelists comment as well. I think there's often a focus on reporting or a sense that reporting is this mandatory burden that issuers have to bear, that there's a requirement to go through this process once a year, and it's all a bit of a headache. I guess the message that we try and convey when we speak to companies we own or are potentially looking to investing is that there's actually quite a lot of, I guess, self-interest into this. So if you look at the reporting from a corporate perspective, the reporting should be a function of and feed into discussions around strategy and business resilience that the corporate and the board, one would hope, are already having. And if you're not having them, then the reporting process should hopefully kickstart some of those discussions where you think, crikey, if a carbon tax goes to X level, then what does that mean for my business? But also, if you look from a nation state basis, and there's a degree of self-interest here in terms of understanding the degree to which we could have stranded assets or stranded business models, which has a clear implication, particularly for Singapore, as we've heard many times over the last few years. But also from a capital markets perspective, you're seeing a lot more capital being deployed, looking for companies who have this more resilient business model and are able to communicate that business resilience through their reporting. And you're seeing capital being moved away towards companies that have that resilience and report on that well, and potentially away from companies who don't have that resilience or at more risk, or more importantly, not necessarily communicating the way that they're managing these risks So there's a degree of self-interest there that if you want to attract global capital flows, if you want to get access to the sort of trend of green finance, then that better reporting is also helpful. So what we would try and emphasize is this is not a burden. This is not a, oh gosh, another year of reporting on sustainability. What a headache. There's actually quite a lot of positive elements that we can take from this that should benefit, you know, the companies, the nation, and also capital markets, as well as we look to effect change. So there's a positive reinforcing mechanism here.
Yeah, actually, let me add on to that. I think David is spot on, right? The difference between the conversation on sustainability today versus a few years ago is you get that sense that sustainability as a topic has truly gone mainstream. And the reason it's gone mainstream is due to the strong alignment between national governments, asset managers, as well as corporates who are on the sustainability journey. So you're spot on. The way we think about it as the financial intermediary who manages, you know, capital flows, liquidity flows, credit origination, is well looking at where the future of these economies are going based on national development plans, based on where our clients are going to be transforming their business models, and where asset managers are going to be putting their investment dollars. And it makes perfect commercial sense to be able to build a loan portfolio, a fee-based income, a revenue model that supports a sustainable outcome and be able to wean ourselves off old economy type revenue models, because simply for good business sense. So I agree. I think sustainability reporting needs to report what the business does as business rather than be a standalone thing.
Thank you, Eric. Thank you, Eric. Maybe I will want to round off this very good, exciting panel discussion in this way, because I'm seeing a lot of common questions, and I will integrate again. And I think this will lead to our broad ending. Just now in our panel discussion, we talked about having this holistic approach. So in one of the questions in Q&A, there was this articulation about how do we deal with all the SDG, the 17 of them. And then there's another question on the essence of risk, because risk is actually the most fundamental parameter, the foundation. And there was one question on, are there anything we can learn, perhaps look at best practices, particularly from the EU. Of course, they have many new policies, carbon trading, taxonomies, and all that. So how do you piece all two together so that, you know, in a very holistic way, in a very coherent way, we can convince company that it is about an existential challenge, you know, looking at the higher purpose of sustainability. Don't say it's someone else's problem, it's our own problem. It's not that it's someone else, you know, the whole, we're all in the same boat. It's not the hole at your end. If there's a hole in your end, all of us sing. So can I give all the panelists a 30-second opportunity to do the broad ending? You can have your last piece in any sequence.
30 seconds is really tough.
Okay,
yeah.
1 minute. Okay.
I just wanted to speak to that. I think on the questions, right, and it's a perennial problem globally, right? People have difficulty integrating, you know, there's so many frameworks out there. So what we say that in the sustainability space is like an alphabet soup, right, of standards, and it is confusing, and you do need people to hold your hand. So I think to this end, there's work being done globally, and I just want to give a plug, you know, to the work being done by the IOSCO Sustainable Finance Task Force. So MAS is very involved in that. We are co-leading as well with the US SEC on the technical expert group. So what the IOSCO STF does, what we're trying to do currently, is actually to come up with a harmonized sustainability standards, set up an international sustainability standards board as well. So the hope is that you have a global governance structure that everybody buys into, and then we are working on the content of the sustainability standards. We are working off a prototype which was put together by the top 5 sustainability standard players currently. So the work that we're doing, we hope that the new ISSB is set up before November, and then the content will be landed on fairly quickly as well. So hopefully once we have a more unified standards, right, it'll be easier for corporates globally. So I think that's going to help a lot to speak to those issues. And maybe just to round up, I think sustainability, we always say, is an existential issue. And I think David and Eric have already said that, I mean, you have your investor here, you have your financier here, and I think basically that's what your investors and what your stakeholders need. So speaking directly to the businesses, it's not checking the box. It's not a bother, because to effectively manage your sustainability related risk and opportunities, right? You will need to do this. To build your business resilience, to have your long-term enterprise value creation. So it's not just the regulators wanting to do it per se, actually it's what your stakeholders need as well. Thanks, Prof.
Thank you, Abigail. Maybe we have one more of my colleagues on the panel. Who wants to go next?
Prof.
Okay, Lynette, spell sustainability in 1 minute.
Actually, what Abigail said is very true. I think it's the whole ecosystem here that we're operating in. And for many companies, I think we have to look at sustainability as part of your business strategy. It is no longer a good to have, but it is a must have. So if you were to mainstream that into your business operation, you're looking at future-proofing your assets, future-proofing your company to ensure sustainability is about longevity of your business. So it is about building resilience. But on the other hand, we also want to look at it from the value creation perspective. Because once you're able to be more resilient, there's so much consumer and corporate preferences that are moving towards sustainable products and services. So as you begin to look at the risk perspective, you also look at the opportunities perspective and see what value you can gain out of it. So one of the very ambitious things that we ourselves are doing is to come up with a metric called return on sustainability. It is still a work in progress, but what we want to do is to find out in each of our investments, other than the typical financial performance, IRR, we look at ROS, return on sustainability. Work in progress. But...
Thank you. Return on the sustainability we have. David and Eric, make it very crisp. Our ROS will be very, very big. Yeah. Okay. Maybe David first. Yeah, David.
I'll be extremely quick, but on the SDGs, it's extremely clear that these are big, ambitious goals that we've got for the world. It's clear that governments around the world are aligned with this. It's clear that there's not sufficient public capital to effect change. And so governments will need to work with investors to achieve these SDGs. And I think as a corporate, if you're aligned with solving these SDGs, that's an incredible tailwind. And if you're not aligned with solving these SDGs, then that's going to be an incredible headwind as you look to go about your business and attract capital.
Okay, thank you, David. We're very crisp. Okay.
One word.
Eric,
guys,
okay.
It's all about impact. So in everything you do and everything you report, exactly to my fellow panelists, just keep your eye on the ball in terms of the positive impact you're creating, and then you'll be fine.
Wow.
Thanks.
I'm happy to hear that from the banker. It's all about impact. Okay, not about your creditworthiness. Okay, I think it's very good. Let me just round up. I think it's very good. The good news is we have a total of 33 questions online, and I have summarized and integrated the gist. Let me assure you, for all the people who have submitted questions, we will save the file of all the questions. SGX and my team will analyze and go into detail of these questions. We might even share with the panelists so that you know what comes out in our discussion. Not to worry, we'll rigorously and diligently analyze the question. So with that, let me end and thank all my fellow panelists for all the passion in this discussion. And with that, let me hand back to Rainer, the host. Rainer.
Hi. Thank you very much, Professor Loh, and all the panelists, Abigail, Lynette, David, and Eric. Thank you very much for sharing your insights to this very important topic. I would now like to invite Mr. Tan Boon Jin, CEO of the SGX Redco, to share his closing thoughts. Boon Jin, please.
Thank you, Rainer. Minister Grace Fu, Professor Andrew Rose, ladies and gentlemen, good morning. Thank you, Lawrence, for that lively presentation, and to our panelists for an equally spirited discussion. We have heard a lot about the need for businesses, governments, and regulatory bodies around the world to play their part in helping to tackle climate change and step up efforts to promote sustainability. At the same time, investors are increasingly conscious about sustainable investing options, and more will likely choose this kind of investing in the future. These trends put sustainability reporting front and center. Rather than a nice to have, companies are beginning to find that their reports are receiving much more attention. We mandated sustainability reporting in 2016, and encouraging progress has been tracked since then. This year's review of reports shows marked improvement versus the last assessment carried out in 2019. But the need for more granular and transparent reporting will only increase. While we now benchmark the extent to which sustainability reporting has been embedded by listed companies in Singapore, we know further progress is needed. So, where do we go from here? In considering this question, I would like to reference the recent keynote speech by Mairead McGuinness, European Commissioner for Financial Services, Financial Stability and Capital Markets Union, at a high-level conference entitled Proposal for a Corporate Sustainability Reporting Directive, The Way Forward. In her speech, Ms. McGuinness touched on the opportunity to strengthen the European economy and society by making the right choices through sustainable investing. In order to do that, comparable and reliable information is critical. This is where the proposed Corporate Sustainability Reporting Directive comes in, to set out the sustainability information needed from companies in the EU. Ms. McGuinness focuses on two elements of the proposal: clarity and coherence. Turning first to clarity, in her remarks on the need for enhanced clarity, Ms. McGuinness addressed the fragmented landscape of sustainability reporting. She echoed growing calls for the convergence of standards to establish an EU sustainability reporting framework that will be able to create consensus about best practice information that all stakeholders can expect. Europe has an abundance of differing reporting standards. We are dealing with a similar challenge here in Asia. Calls for standardization and ways to improve comparability have increased. It is imperative that we as regulators respond by identifying ways that will better disclosures. We need, therefore, to discuss and decide whether a harmonized standard and assurance for sustainability reporting are necessary for Singapore and across the region. And if so, how to go about getting there. At its core, a harmonized standard means reporting the same things in the same way. It is, of course, ideal to have a final authoritative list of things to measure and ways to measure them. But this is not something that needs to result in the binary outcome, and we are only too conscious that time is not on our side. We are better served by adopting a targeted approach in the interim to address the most pressing areas first, even if this means starting with chapters rather than verse. Increasing stakeholder and shareholder confidence in the accuracy and completeness of information is also crucial. This indicates that assurance will continue to grow in importance over the coming years. As you saw from Lawrence's presentation earlier, currently, few issuers are obtaining assurance for their sustainability reports, though the trend points to an increase from 2019. This is further compounded by the scarcity of external assurance. For now, the SGX Sustainability Reporting Guide outlines recommendations for listed issuers to internally verify reports before progressing to obtain external assurance. Realistically, companies can expect that external assurance for sustainability reporting will eventually become a requirement. We're also keeping a close eye on the debate around the fiduciary duty of board directors to consider climate issues, because, as the panel highlighted, these are a growing priority for issuers and stakeholders alike. All these may well translate to a demand for assurance both within and without the boardroom. Turning now to coherence. In her remarks, Ms. McGuinness also talks about the central role coherence plays in the EU strategy, with the need for reporting standards to be aligned with the EU's own green and climate neutrality goals, as well as global initiatives. alignment with the global markets must be taken into consideration as well. The European Commission's proposal incorporates core concepts in the recommendations of the Task Force on Climate-Related Financial Disclosures, TCFD. In this regard, Ms. McGuinness mentioned the need to see global standards as a floor, but not a roof. This is a point that I believe we should adhere to. Alignment to global climate-related disclosures should be a minimal benchmark for all companies. As highlighted during the panel discussion, a consensus appears to be building around the recommendations of the TCFD. We ourselves are planning to consult the market on whether we should incorporate their recommendations into our rules. This will thereby set a regulatory floor to climate disclosures. I must make clear at this point, though, that our issuers are already cognizant of climate matters. As you saw from Lawrence's presentation earlier, almost half the listed issuers already discuss climate change as an economic, environmental, social, and governance, or ESG factor, in their sustainability reports. And for around 1/3 of listed issuers, it is a material topic. To conclude, in the past few years, we have seen an exponential rise in the level of interest in sustainability. And when the COVID-19 pandemic struck, it sparked a catalytic change in the way issuers looked at sustainability and ESG factors. As sustainability reporting practices around the world evolve, our role as regulators requires us to be a guide for companies in terms of measurable and comparable information. While we have seen an overall improvement in sustainability reporting, more must be done, especially in terms of the depth of disclosures. In the coming months, we are looking to launch a public consultation on our own sustainability reporting rules with a focus on climate-related disclosures, as well as the question of assurance. I urge issuers to join us in raising the floor to drive companies and society towards a more sustainable and greener future. Thank you once again for joining us. Thank you very much.
Thank you very much, Jin. Ladies and gentlemen, we have come to the end of the forum. Before we close, on behalf of SGX RegCo and the Center for Governance and Sustainability, I'd like to thank Minister for joining us this morning. And to all participants, thank you very much for staying with us, and we hope this conference has been insightful. As promised, you'll now see on your screen a QR code which you can download the full reports and findings presented by Prof. Loh earlier. We have now come to the end of our event. Once again, do stay safe and take care. Thank you very much.